Now, welcome back to the second episode 2. So we talked about in the first episode, we talked about what is it? The budgeting, as in how much comes into your coffers, and then how much you are putting for particular purposes. In fact, good purpose, not any folly purposes. You understand? So we have dealt with the budgeting. How much is a portion for this particular reason, and for that matter, it should be a need, not just a want or a wish. So that is so. Now we are going to continue with what savings. So in savings, in fact, let's have the reading now. Importance of saving now. Essential for financial security and emergency what preparedness, right? So we save for what? Emergency or for security reasons, right? So that is it. You save, you are being paid after taking your needs, right? What is important, your physiological needs, right? Then you move towards savings. So it means that if you have not taken care of your physiological needs, then you can't be taking care of your savings. How can you be hungry and be saving? So it means that you should have enough for savings. You understand? So that is it. Listen to this very carefully. You should have enough for saving. If you don't have your needs, you can't be taking care of savings, right? So and then we have different types of what? Savings. So the savings what? The money that came to your coffers as employee, right? After taking that your needs, then you take another portion called your savings. Now savings come in different types, right? Now strategies set aside a portion of income regularly, right? Create an emergency fund, as in 3 to 6 months of expenses, and use savings account. Now yield high yield savings account or certificate of what deposit, CDs, right? Now, what is the importance? The importance of this is that you are what? Taking care of what? Unforeseen circumstances, emergencies, sickness, accident, death. In fact, deaths and deaths, as in people dying, and then for you owing, right, or for you borrowing. So that is it, right? So in fact, this is easy. Now, when it comes to savings, in fact, there are a number of types of savings, right? We have savings that you can actually go and withdraw, and then at the same time, some savings that you cannot withdraw, right? So it depends on the type. So you have to do that. So not the regular one that we do at the bank or on our mobile phone, mobile money, is the money that we just keep there in case you need something, and then that. So that doesn't also mean that you should be using or be squandering, because that is savings, right? So you have to decide. I can't decide for you the type of savings that you go into. You understand? So I think that we have different types. The video will not permit us to be looking at all of them. You can go seek some financial advice from your banker, and then that will be good to go. Now, there's this portion that we will talk about. Yeah, sorry. So after taking care of your needs, right, your savings, we move towards investment, right? So everything is in what? Sequential order, chronological order, right? You don't bypass the other. You should follow in that sense. You should have your needs. If you should have food, where to sleep, right? Your clothing, your hospital bills and all that. You should be able to take care of that. Then after that, you should be what? Apportion a kind of amount of money from your income, because no money is going to come. No, you shouldn't be expecting. People live like they expect people to be dashing their money. Have you been dashing people for money for this kind of thing? So everything that we are doing here is from you. Everything coming from you. So if anybody gives you money as a present or whatever, then as a present, it's okay. Then hallelujah. But whatever we are doing here is everything starting from you, initiating from you. So that is it. Starting from you, starting with you. So that is it. So we go to investment. Now let's read. Now, basis involves allocating money into assets like stocks, right? Bonds, mutual funds, or real estate to grow wealth over time. Now, this is why in our introduction or in our topic, we talked about financial literacy and at the same time to the financial market. So this will actually give us a glimpse into what is called financial market, right? So I will talk about it. It's actually a broad topic that I can't actually uh, address all of them here. So we see at the end of the video or at the end of the other episodes, right? So what is the concept? To understand the risk return, diversify investments to manage risk, sorry, and start investing early to take advantage of compound interest. Now, basic investment options include the stocks, the bonds, the mutual funds. There are a lot of them. Then the concept of risk and return. So we are going to look at it briefly from whatever I say. So after keeping for or taking portion for savings, you should have another portion of the total income that we are talking about. You understand? You should have another portion of it for investment. So there are different types of investments. In fact, there are a lot of them. We have some that are, in fact, the duration for that. We have some are, how do what do I say? So, some that you can roll over. In fact, yeah, that's the term that I was looking for. You can roll over. Maybe you invest for a month. Sorry, at most 3 months. I think Treasury bill in Ghana, I should say, the minimum period is 3 months. And then 3 months, they have a percentage that will give you on top. So let's say if you invest 1,000 and they give you, let's say, I guess for scenario, 10%, then that will be 100 cedis. So this 100 cedis at the end of the period will be added to your capital or your principal. So that will be 1,100. You understand? So that's at the end of the period. So you can go to 6 months. So the longer the period, then the higher the percentage or the return, the return rate. You understand? So that is the idea of what investing. There are some you can go in for 1 year annual, some 5 years, and then some 10 years, some even 25 years. So the longer the period, the higher the return, the return of what the return rate. Now there's a downside to this. Oh yeah, I can call it that way. A downside to this, meaning there are things that you have to seek consultation, right? Financial knowledge, right? Or guidance from experts. You understand? So for them to actually discuss with you to know your risk tolerance. So your risk tolerance is how much you are willing to risk into getting another particular thing, because every investment has a downside or risk involved. There are some the risk involved is 100%. There are some the risk involved is 50%. So the 50% means that it's either the investment comes out successfully or it gets bad, and then all the whatever money that you invested is gone. But notwithstanding, it means there's a higher return attached to this. So you have to know your risk tolerance, right? There are some people, if their $1 or one CD gets missing, they are going to make her run loose, right? They wouldn't. In fact, they can't afford $1 or one CD to get missing or get into debt, or yet you understand. So you have to know your risk level, and then with an expert, you understand. They'll give you some guidance. You want to go to the bank where you save, you can talk to them about the investment opportunities. You understand? So all these that I'm talking so far are the traditional way, right? From the bank, from people, from friends, you understand? And then when we move to the financial markets, right, it's where we talk about the stocks. We talk about the bonds. We have to talk about the mutual funds. We have to talk about the FX, forex trading. We talk about crypto investment, investing in crypto. So that is it. So you have to apportion some money. Now, doing this, you have to make sure that there's something we call diversified portfolio, right? It means you don't invest into one particular thing, right? You have traditionally from the basics idea, the explanation, that's what I'm giving. You don't invest into one particular thing. So you can invest into stocks separately, invest into what? Bonds separately, invest into mutual funds separately. You understand? So that you do this to what? To hedge your risk. You understand? There's a term for that. If you don't understand, check it. You are hedging yourself, protecting yourself from any unforeseen circumstances in the investment, because some investment can run into what? Into loss. You understand? So this is very important. If you want to do that, you have to seek advice, and then that is it. Or whatever, whoever you want to do that with, you have to have a structure. MOU, you understand? Agreement, you understand? So that is it. It's very important to understand this. Else, please don't venture. You have to know your risk tolerance. That is it. So, um, now let's talk about credit. Now, credit, understanding credit scores reports, how to build and maintain good credit. Understanding credit, right? Understand credit is a borrowed money, but borrowed money that you can use to make purchases, which you must pay back with interest. That's credit. So tips: pay bills on time, keep credit card balances low, avoid taking unnecessary debt. Now, let me combine that. Let me combine debt credit with debt management. So let's go. Now, debt is what? Strategies to pay off. Let's look at the strategies to paying off what? Debt. Types of debt, good debt, and then you understand. And then we have bad debts. You understand? So now, let me give you a summary of the credit and then the debt. You see, many a time you hear people say that debts are very bad, right? You borrowing is very bad. Now, I beg to differ. The actual thing should be that debt can be a good thing and at the same time a bad thing. Why do we say this? The point is, don't go and borrow money or be in debt for your wants, right? You hear people borrowing money just to organize some parties, buy some clothing, some fancy cars and buildings and things. So it means that don't use debt to for once. Things that will not give you any benefit in the long run. So you can only make go into debt or borrow money for business purposes. You understand? So that is what it means. Don't borrow money for your wants, for your wishes, for any some will say, excuse me, say schedule reasons. So whenever you are going to debt, make sure this debt is for a business, if for maybe entrepreneurship, starting a business or doing something tangible, something that will give you benefits in the long run. You understand? So borrow money to make money. Don't borrow money to be robbing Peter to pay Paul. There are some people, they will borrow money, and then when the time is due, they will go and borrow from another person and then go and set that debt off. So in the long run, in fact, they become drowned in debt and they can't actually come out of this. So every day they live from hand to mouth. And coming out of this is very difficult. Some even try and be committing suicide because where their level of debt has gotten to, there's nothing they can do about it. It can bring shame, right? People not being able to live in their houses, their homes, or even going to some places. So that is it. So borrow money for a good purpose. Borrow money for a business venture, right? That is it. So it means that we have good debt and bad debt. So that is what, in brief, we can say now. So we end here for the second episode. Then we continue in the third episode on ways to what? Invest. Thank you very much.